Welcome back, dividend growth and value investors. It's been a while, don't you think? No worries though, work just kept me really busy. C'est la vie. But hey, today we're delving into the top 5 dividend growth stocks that are owned in the Facebook Dividend Talk community. This is a community where passionate dividend investors share their thoughts, experiences, and most importantly, discuss not only US dividend stocks but also those from Europe and elsewhere in the world. If you haven't joined yet, feel free to do so via the link in the description below this video. Now, before we jump into my quick take of our first featured dividend stock, make sure you hit that subscribe button and ring the notification bell. You then won't miss any future upcoming video as I'm back and I aim to publish videos on a weekly basis again. Alright, without further ado, let's get started. The single most owned dividend growth stock with a top 5 position in our portfolios is Realty Income. Realty Income with ticker symbol O is a well-known and popular dividend growth stock often referred to as the monthly dividend company. It has already paid 637 monthly dividends in 103 consecutive quarterly increases. It has been therefore growing its dividends since 1994 at a compounded annual growth rate of 4.4%. What is important to know though is that it operates in the real estate investment trust sector, which means it must distribute at least 90% of its taxable income to shareholders in the forms of dividends. But good news though, because the company owns a really diverse portfolio of commercial properties across various industries including retail, office and industrial. This diversity helps mitigate risk and provide stability to its income streams. What is also good to know is that Realty Income's properties are often triple net leased with long-term lease agreements. Many of these leases include built-in rent increases over time, providing a source of predictable income growth. Having said that, triple net lease is a type of commercial real estate lease arrangement in which the tenant is responsible for paying not only the base rent, but also the majority of all the property's operating expenses. Think for instance about the net property taxes, the net building insurance, and the net common area maintenance like landscaping as an example. What is important to know though, as a real estate investment trust, Realty's income performance can be influenced by changes in interest rates, because when interest rates rise, it could impact the cost of financing for the company and potentially therefore affect its valuation. I think also therefore that it's not anymore trading at $70 but rather at $60. Besides that, I think what you should really know about Realty Income is that the company is already so large and owns so many properties in the United States that it only becomes more challenging to find profitable growth. This is one of the reasons why Realty Income started to expand in Europe, and you can see that here. It owns 10.5% of its assets in the UK as an example, but it also owns currently some assets in Spain. I'm still a bit on the sidelines because I think Europe is a really difficult area to operate in, so time will tell if the market is profitable enough for them to grow it meaningfully. Having said that, enough about Realty Income's business for now. Let's dive into their fundamentals, but before doing so, let me share again how I look at investing in dividend growth stocks. First and foremost, I'm looking at dividend stocks with a safe dividend profile. The last thing I want is a company cutting their dividend during stressful times, because that might be the moment I need dividends the most. Hence, a safe dividend profile for me are companies that have a few tailwinds to continue growing their revenues, like a catalyst or a moat. They have been growing their earnings and free cash flow over time. They possess a healthy balance sheet, have enough room to grow their dividends due to reasonable payout ratios, and have a proven commitment to dividend growth, for instance by a very well articulated dividend growth policy. Only after that I look at their valuation to assess if now is the right time to buy. So let's have a look at Realty Income then. In my opinion, Realty Income has a safe dividend. And actually a score of 66 means just above questionable, because my range is 60 to 80 for safe and 80 to 100 for very safe. In the questionable zone, it will be in the danger zone. Now, big disclaimer here, I believe I'm a bit too tough on Realty Income. The reason for that is that I look at those different metrics here and it's getting punished a little bit hard, because the main thing you need to look at for a company like Realty Income is funds from operations. If you don't know what that means, I think it's good to look it up a little bit, because real estate investment trust companies are typically evaluated like that. That's one of the key single metrics. Now, what I've done in my dashboard, I've used free cash flow as funds from operations. But net income or earnings per share is not really a metric we look at, and that's why it's been punished a little bit harder. I believe if I would take those points out, it will probably score around 76, which is a really healthy dividend score. I do believe though that there are no strong growth prospects for the company. I think we will see it growing just slightly above inflation in the upcoming years. But of course, it has a really strong commitment to the dividend. It has been always increasing the dividends to the last few recessions. So that's really, really strong and why the company scores relatively well in the dividend safety score. Having said that, what I believe it's currently worth now is somewhere within the mid-50s of dollars if you really think about the fair value price. It has 29 years of dividend growth and a current dividend yield of 5.18%, which is really good. The payout ratios are healthy, around 75%, and they can even pay out a little bit more if needed. Now, if you then look at it, their funds from operations has been growing really rapidly, but that's also because of the acquisition from VRite. Now, if you would only look at this, you would think that this company has been on fire, but that's where it's really important to know one thing. If you look at this here, the free cash flow per share, you see that it has been just slowly growing. The reason for that is that a company like Realty Income uses share issuing to fund for new acquisitions, as it has done for VRite. So in 2016, it had about 256 million shares outstanding, and currently we're talking here about 647 million shares outstanding. That's the reason why you really need to look at funds from operation per share, which in this case is around $4. If you take that number, then we're talking here about a price to funds from operations of about 15. In my opinion, this is a pretty fair value. And if we then take those funds from operations and assume a 5% year growth in the next 5 years and then 3% thereafter at a 12.5% discount rate, that's the money I want to earn on my investment, then the company would be at a fair value per share of $53. But look, if you just expect it to increase a little bit more and grow a little bit more over time in the next few years, and therefore 6% and 4%, and a terminal multiple at 18 for a high quality comp, it will be worth around $61. Hence, the company is currently trading at $59, and honestly, I think that's an attractive price to start investing in a high quality company like this. If you also take the dividend discount model and you use the $3.07 per share that currently paying at a 12.5% discount rate, and you expect the dividend growth rate to be 7.5% or something like that, in that case you will also have a fair value of $61, which is around the price you pay today. So in my opinion, it looks pretty much attractive, and expect me to add a few more in the upcoming weeks. But hey, this was all about Realty Income. I can imagine you still want to know more about it. Not too long ago in the Dividend Talk podcast, episode 148, we have done a full business breakdown of Realty Income. I'll put the link in the description below this video and you can have a look at it and listen to it. So far, it has been one of our most popular Dividend Talk podcast episodes. Good, so let me try to speed up now a little bit because the second stock I think needs no introduction, and it is Microsoft. And I'm showing you the chart here of the dividend growth history because many people don't see Microsoft as a dividend growth stocks. They see them as a growth stock. Well, there's of course some truth to it because their growth has been stellar. But just have a look at this. Don't tell me this is not a dividend growth stock as well. One doesn't exclude the other. Now, if you look at the business units of Microsoft, it exists out of 3 business units: Intelligent Cloud, More Personal Computing, and Product and Business Processes. Now, of course, the one that has been in fire over the last few years has been the Intelligent Cloud with the rise of Azure. For me, this was really brilliant of Satya Nadella build up here, and it's currently the basis of many of their other services. As an example, OpenAI. What a brilliant investment there. 10 billion into OpenAI. Yes, OpenAI has a profit cap, but you know, the brilliance comes really into the fact that they have a deal that Microsoft and OpenAI can only be used on Azure. They can sell now all these large language model services via Azure to their customers. I don't even want to know how many businesses are currently trying to explore the power of this, because I tell you, working in IT, I truly believe of the productivity gains that these large language models can provide here. Even in my own personal space, it helps me already a lot with just saving time. Last but not least, what you don't see here yet is the Activision acquisition. It will come into the more personal computing, and I'm looking forward to that as well because I believe it can give a little bit more revenue and income growth to the Xbox franchise. Now, if you then look at the revenue that these business units generate, what you can see here in the last quarter, which was ending in June, productivity and business processes generated 18 billion, intelligent cloud 24 billion. And the impressive thing about it is that it's really on fire because it has been growing with 15% year over year. Now, you might say here, of course, hey, EDGI, that's fine, but this stock is way too expensive. Well, have a look at that. First of all, dear dividend safety, do you know that in my own personal database, this is the only one that has the maximum score of 100 points? And it should not come as a surprise because their growth prospects are still very strong. They have a really strong dividend growth history. Their free cash flow growth and EPS growth has been on fire. They have the best balance sheet in the world. And their payout ratio is really around the 30%. I mean, this is just one of the safest dividends that I've ever seen in my life. Now, if you look at then at the last year trends, here you can see that until 2016, the company was struggling. And then when Satya Nadella came at the helm, just their earnings have been on fire. They have been consistently buying back shares. For me, they can stop it because they are doing it at really expensive prices, in my opinion. The company is definitely not largely undervalued. On top of that, if you look at the cash allocation from the free cash flow, they still have money left at the end of the quarter, even after paying 19 billion or almost 20 billion in dividends and 22 billion in share repurchases, because they are able to generate a free cash flow of about 60 billion per year. This is really an insane amount of money. Now, and we can see that then translated back into the balance sheet because they have so much more equity and cash on the balance sheet than their long-term debt. So no wonder it has the best balance sheet in the world. So if we then look at the valuation, first of all, I believe that my fair value is still low in the low 200s, but there's a catch to this. If we take 60 billion here at a growth rate of 12%, and we saw it's doing a little bit more over the last few years, and then 10% thereafter, at a 12.5% discount rate and a terminal multiple of 20, which I think is valid for such a high quality company, it should be worth 216. But the catch comes here. If you believe that the company can keep on growing at the current pace, which is about 18% annually, and then 13% thereafter, and therefore we should also value it a little bit higher with terminal multiple of 25 after 10 years, then yeah, this company is currently worth $360, which is slightly above the current share price. Now, that's of course a question. I believe the truth lies somewhere in between. I believe like in the high 200s is probably worth adding something, specifically when you think about the OpenAI catalyst that they have currently. And also if you think about the price to earnings is currently 33, 34, which is a bit too hot, so it should be able to come down a little bit when the opportunity arises. So to conclude, Microsoft is on the expensive side. I'm not buying it right now, although I do have some more thoughts about it, why I let my winners run. If you're interested in that, check one of my last articles on my blog, the 500 billion revenue 2030 ambition. And I explain here a little bit why I'm not selling Microsoft and why I let my winners run. Okay, so let's go then to the third company. And the third company that is most held in the top 5 by the Dividend Talk Facebook community is British American Tobacco. So if you don't know British American Tobacco, it's one of the classic tobacco companies, a strong competitor of Altria and Philip Morris. Simply said, they sell cigarettes plus some of the new vaping stuff that you see all those new youngsters walking around with. In 2022, they made about £28 billion in revenue. Now, what you should know about Barclays is that they are totally focused on a strategy that they call, ironically, building a better tomorrow. It's up to you whether you believe it or not. I find it a little bit sounding like a woke strategy, but okay, it is what it is. But in a nutshell, it comes down to it that they want to move away from cigarettes to kind of more healthy smoking products by transforming into multiple categories. But while the company talks a lot about this, reality is that at the moment, if we look at the first half year performance, they made 13.4 billion in sales. Of that, only 1.6 billion is in these new categories. So we're talking here about, 13-14% at this moment in time. Even though it's growing at 29% year over year, it's still not really a big business unit. And also, if you think about that group revenue was only growing with 4.4%, then there are two lessons to take away from this. Firstly, probably these sales are heavily cannibalizing the existing sales of normal cigarettes. Secondly, normal cigarette sales are also slowly declining. So it's really important for them to move into these categories, but it will take quite a while before it becomes really the driving revenue generator for a company like British American Tobacco. Because what makes this company so interesting, and that's definitely the high dividend yield. You can get this company for about 9% dividend yield right now. But is their dividend also safe? Let's have a look at that. So in my opinion, their dividend is safe. Why am I saying this? First of all, they have been able over the 5 years on average to really nicely grow their free cash flow and their EPS. They have a decent balance sheet, but of course they get a bit of a lower rating than other companies because generally tobacco stocks are out of favor, which also means that their future prospects are not as strong as, for instance, stocks in the information technology sector. Because if we look at it, their debt to equity is actually really decent with 50%, and an interest coverage of 7.6% also means that they can easily pay their interest. At the same time, they have currently also a relatively low payout ratio, around the 50 to 60%, which also means that they have still quite some room to grow compared to, for instance, Altria or Philip Morris. And at the same time, they have been really committed to their dividend growth. They have continued to increase it during the recessions, and their average growth is around 5.75%. So if we then look at what I would pay for this company, I honestly believe that this company is heavily undervalued. It's currently trading at £25 and a little bit of change, while my fair value is around £42 and a little bit of change. I'm taking here 9.2 billion of free cash flow. If you look over the last 5-6 years, it should be definitely able to make this. And if we then even take really low grow percentages for the next 5 years, 4% and 2% thereafter, and again at a 12.5% discount rate, a terminal multiple of 10, really for an out of favor stock, it would still be worth £41 and a bit. So if you look at that, definitely heavily undervalued. Even the Chowder rule, if you take 9% plus almost 6% in dividend growth, we're talking about almost 15%. So for me, if I look at the entire top 5, this is probably one of the most undervalued companies that our Facebook users in the community are currently having as part of their top 5. And it tells also a little bit about how smart you guys are. Good. This was British American Tobacco. Let me then go to the 4th stock that many of you in the community are owning. Because this is T. Rowe Price Group. If you don't know the company, it's a well-respected investment management company that offers a range of services for both individual and institutional investors. Many Americans will probably know them because of their 401k plans. So what is important to know here, in their strategy, they are focusing also on further globalization to continue to grow their client base, because this business at the moment is not an easy business. They currently face quite some competition from passive alternatives, the low index fund investors. They have also pressure on the fees because of that. So this is definitely something to take into consideration. But T. Rowe Price is aware of this, hence why they are expanding internationally. And I think this is a good thing to do for them. And I can also see them being relatively successful into this. Now, what's the one single metric that many investors look at when they are thinking about T. Rowe Price? That's their assets under management. Now, what you can see here is that since 2018, it has really blown up from 962 billion to 1.7 trillion almost. Of course, in 2021, everyone was putting their COVID money to work. That's where T. Rowe Price really benefited from. And then in 2022, it kind of fell off a cliff to 1.3 billion. And now it started slowly to recover again. And it feels like it's a little bit again within the normal trend that we have seen in the years predating 2019. Well, the good news here is because of this, the stock price also went significantly down from around $200 to approximately $115, $120 right now. And it's trading at an above 4% yield right now. But this is dividend safe then. Now, what I really like about this company is that they have no debt. So even Microsoft has debt on the balance sheet, but T. Rowe Price has nothing there. And this is on purpose because they know that they are in a cyclical business. They heavily depend on the fees they get from the asset under management. So they are at all times trying to protect their balance sheets so that when in bad times, when for instance they are making a loss, they can leverage a little bit up and not deteriorate long-term shareholder value. And this is what we are experiencing now a little bit because their earnings are under pressure. You can see that the 5-year average EPS growth have been only 2.4% because the spike is gone now. And the free cash flow payout ratio has spiked up as well at the same time because it stands at 85% right now. Though, if you look at the forward EPS estimates from analysts, you would see that the company is paying out an approximately 50% EPS going forward. Now, from a dividend history point of view, 37 years of increases, I love it, and a 5-year dividend growth of 16%. I don't think it will be the same going forward. They just did a token appreciation hike in the last year, and I expect that over the next 1-2 years to be the same as long as the Rowe price hasn't fully recovered yet. So what is the stock worth then? I believe the stock is currently worth at about $130. What I've done, I've used a little bit less net income than I used to do when I was analyzing it earlier. I set it back to 1.9 billion, which is approximately the 5-year average that we have seen. A growth of 7% should be possible and then 4% thereafter. At a terminal multiple of 15 should give you like $131 in value. Currently, the share price is standing at $115, so it's about 10-15% undervalued in my opinion. I bought some more T. Rowe Price recently, so I've got already quite a large position, but on the dip, I might consider buying some more. Well, stock number 5 then, and the last one, which is the most voted in the top 5 of the Facebook community, is Ahold Delhaize. I've spoken a lot about this in the past, but if you don't know this company, it's a supermarket retailer from the Netherlands. It's a combination of Ahold and the Belgian former Delhaize, which Ahold bought in 2016 approximately. They currently make a net sales of 21.6 billion and 60% of that revenue comes from the United States. In the United States, you might know them from brands like the Giant Company, Food Lion and Fresh Direct. And in the Netherlands, it's very much known for Albert Heijn and their digital Amazon equivalent called bol.com. Now, what's important to know, this week, I think on Wednesday, they will report earnings. But if we look at the last first quarter earnings, it looked pretty much okay. They had an underlying operating margin of 4%. That's what you kind of can expect from this company because generally supermarket chains are low margin businesses. They had an underlying EPS of 61 cents. And they had a comparable sales growth, excluding gas, of about 6.2%. And I believe that in the last quarter at least, US was really pulling the company forward. Now, if you then look at the expectations, they are expecting to make around 2 billion in free cash flow in 2023. And of this free cash flow, buy back shares at the volume of approximately 1 billion. At the current market cap, we're talking here about 2.5% to 3% buyback yield. And that is one of the nice stories about owning Ahold because they have been doing this for the last few years. So let's go back then to my dashboard to see the dividend safety profile. Look, the dividend is, in my opinion, very safe. They have a decent balance sheet. You need to know that high debt to equity is not that bad for a company like Ahold Delhaize. The reason is it's a really predictable business. It is anti-cyclical. It's a slow growing business. And therefore also they can leverage a little bit more up because this business will not be wiped out overnight. You will get so many alarm signals when this would happen and also the company. And at that moment in time, they can just stop the buybacks and pay down the debt if needed. Also from a payout ratio point of view, they have a payout ratio around the 50 and the 40s, which is relatively low in my opinion. This also means that I believe that the 5-year dividend growth rate that they had over the last 5 years of 10% should not be too far off. I do believe it will be a bit lower, maybe 7 to 8%, but this makes this a very attractive story. Now, if we look at the current yield, this is about 3.4% right now. So it makes really a nice chowder stock, although I believe it will be a bit less, as I mentioned before. But in my opinion, the real fair value of Ahold Delhaize at the moment is around 26 euros, assuming a 2 billion that they will make indeed in free cash flow this year, 5% growth thereafter, and a 3% in this year 6 till 10 at a 12.5% discount rate and terminal multiple 14 should give you 25.5 euro. It's currently almost trading around 31 euro. And if you believe that they're able to grow with 7% their free cash flow going forward and 5% thereafter, then you would argue that the stock is even a little bit undervalued. So what is my approach to Koninklijke Ahold Delhaize? I have a buy order set at around 28 euros because I believe that the company is really a premium company. I also believe that it's probably more around 5 to 6%. So definitely then I want to nibble a little bit more in at 28 euros. But hey, we'll see this week. Maybe we get this opportunity if the share price would drop, if they have a huge earnings miss or something like that. Guys, this was it from my side. These were the 5 most popular dividend stocks because they were part of the top 5 of the Dividend Talk community. If you like this video, remember, hit the like button. If you have some questions, if you have some challenges, also please leave a comment. I'm more than happy to answer them, and see you next time.